The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst James Carlisle. G'day, James.
Good morning.
And with us also is analyst Graham Whitcomb. Hello, Graham.
Hi, Gaurav.
Now, gentlemen, we are going to be releasing, I believe over Christmas, but it might be in the new year. So somewhere along this holiday period, we're going to be releasing a list of the top 10 businesses as judged by us. But there is a little twist because one of those businesses, Graham, has been adjudicated by our members. And this was your idea, so why don't you explain what was involved in that polling process and how that ended up? And then I think it's time for a little debate.
Well, the five businesses that we narrowed it down to were Tabcorp, Goodman Group, James Hardie, Reece, and Ramsay Healthcare.
Hey, I want to explain quickly. We actually picked 9 of the top 10, and there's one spot left. And for that spot, those 5 businesses were vying for that spot. And then Graham had a brilliant idea. So sorry. I just wanted to set the scene.
We all picked 10 or more individually, and there was a fairly strong consensus for the 9, and then the last spot was open to debate. So
we each had our favorite, and we needed a little extra assistance from our members to figure out which was the best.
So we had a poll.
Yep. So we put it to the poll. We've got the results. More than 700 came through. Reece and Ramsay, Reece and Ramsay came out on top. They both had a 24 and 25% share of votes. Then there was Tabcorp and Goodman Group, which had 18 and 20% respectively, and James Hardie came in last with 13%.
When will people learn, Graham? Democracy just does not work.
Yeah.
I loved your idea. It was worth the effort, but it produced the wrong result.
Well,
that's my view.
I think that it's important that when you sometimes when you are forced to make that kind of choice, then it just crystallizes the mind. And when push came to shove, we decided maybe Ramsay was slightly better than Reece, even though it got another 10 votes or so. It was the better business.
JC was.
Hold on, I'm not sure about that.
Well, this is what this whole podcast is about. So, in this very episode, the three of us are going to thrash out these 5 stocks. We'll tell you the stock that we each voted for, and we'll run through this list and decide how worthy each stock is. Now, JC was the winner. I think Ramsay was declared the winner. What do you think about that? Is that? I don't think that's what you voted for.
Well, I think it's foul play, isn't it? Didn't Reece get more votes? I mean,
yes. I think there might have been some higher power.
Look, they were very close. They were very close, and there were some question marks about double voting, weren't there, or something? I don't know. Look, when it came to the wire, Ramsay for some reason got the nod, but I was putting my weight behind Reece, my considerable weight behind Reece.
Okay,
the
let's
irony
talk about
is that I was putting my weight behind Tabcorp, and I'm the analyst for Ramsay.
Well, there you go. Well, I had another on the list as well, James Hardie, which got a mention. I think it got 15th, but it was not in really the running for the top 10 for me, but it's still a very high quality business.
Indeed. Well, let's talk about the stock that you voted for, JC. You voted for, what did you say? Reece, was it?
Reece, yeah.
Okay,
Reece.
Explain your decision. Why did you vote for Reece?
The people's vote.
Yeah, well, that's right. The people's vote. I mean, Reece is a fabulous business, and it's proved it over decades with very consistent management, very consistent culture. It's stuck to what it does best. No crazy sort of, it's done a few sort of little infill acquisitions and just built up to become the dominant plumbing hardware supplier in Australia and New Zealand by a considerable way. And there's big advantages in that because it really comes down to the cost of a plumber's time. And if you can save a few hours of that, or even a few days, not having plumbers sitting around, then that's a lot better for them and a lot better for the customer as well. And so by having that scale, by having such a huge network, they have a very, very powerful position.
Regular listeners of the podcast would know from all the jackhammering and noise going on at my house, I've got a little bit of work going on. So I did ask my builder about Reece, and all our plumbing supplies were indeed delivered from Reece. So I asked him about it, and his response was that it was about the service more than anything else. He said that customers 30% of the time can change their minds. The fitting is the wrong one. There's something wrong with it. And with Reece, there's an absolute assurance that you can change your mind. The delivery is always on time. There's never any doubt about the quality or the purchasing decision getting swapped around. It just makes the whole process so easy.
That's right. And they've supported the store network by gradually building out distribution centers around the country. And it's their scale that's enabled them to do this. So they started off with the distribution center in Melbourne. Then they've added them in Brisbane, Perth, Sydney, and Auckland. So they, that gives them this ability to deliver the stock that the parts that the plumbers need, in good time. I think when they opened the Brisbane centre, they estimated it would take 48 hours off supply times for stores in Queensland and northern New South Wales. So 48 hours between that's less, and that's a huge saving. So if you're a plumber, if you're a customer, why would you use someone else? People do, but very hard for them to compete with Reece on price or on service or anything else. And so it's really that element, I think, of the plumber's time, which creates the added value. They've got this scale which enables them to outcompete anyone else. And that's enabled excellent returns on capital. The returns on capital are sort of up in the 20s%, but they're subdued at the moment because of the goodwill taken on with the US acquisition. So that's really pushed down the return on capital.
So tangible capital is even higher than 20%, you're saying?
Yeah, the return on tangible capital is higher. Wow. And of course, it owns half its properties as well, which further pushes down.
Yeah.
So, as soon as you own a property, as opposed to a sale and lease back, as opposed to renting that property, you depress because you're only getting a 4% return or whatever on the property. But, property is an excellent asset. It's in its own right over the long term. And to support a business like this, it gives them security of tenure. They can do the fit out of the store, which is so well known. That's another point in their favor. The stores look so great compared to other plumbing centers, and so they can spend the money on that without worrying about being turfed out.
And of course, plumbing is a cyclical business, and owning your own property really lets you ride out those cycles with a lot of comfort.
Yeah, that's right, and that's why they were able to borrow a lot of money to buy Morsco, the US business. So that's really the next leg is Morsco in the US, where they're trying to do all this over again. And who would bet against them? Morsco is a relatively small player in the US, but in the Sunbelt states down south, it's relatively strong, and so they're trying to build up. Again, that network, those same strengths that they have here, and they're taking a very long-term view of it, as they've always done. That's another great attribute. I'm always nervous to allow too much value for management because it can change in a business. Too much for quality management. But with Reece, really, you could certainly make a strong argument that it's been amongst the best managed businesses on the ASX over the last 30, 40 years.
Oh, yeah. In fact, that's probably why it didn't get my vote, because from my point of view, there's no question this is an outstanding business and one that every investor ought to have on a watch list and aspire to own at some point. But is it a top 10 business? For me, it's outstanding management running and a well above average business, but not. I don't think they're running a top 10 business. I think a lot of the returns and performance attributable to outstanding management rather than outstanding business economics.
You see, the management just takes advantage. They've just maximized their opportunity, but the value that they add and the the lack now of competition because they've established such a strong position. I mean, it's almost impossible to compete with them directly, and earn anything like the same returns. and which gives them the ability to further cement their position. So I think the business is the classic the sign of a great business is one that, to me anyway, adds a lot of value and is you know next to impossible to compete with on the same terms, and that's where Reece is at, and its management has really been uh, you know exemplary in grasping that opportunity. I think that's how I would put it.
Interesting. I think through this exercise, I think we're going to recognize different ways we think about quality in business. Graham, let's hear from you. Why did you not vote for Reece, first of all? And then after you've explained that, I want to get into your selection as well.
Well, I definitely think that all of the 5 businesses that we wrote there are high quality. So I would say that it really did come down to kind of splitting hairs over
Yeah, good point.
which was the best. I mean, Reece is a great business, and everything James said is true. So it's hard to argue against it. But I suppose it wasn't so much that I didn't like Reece. There were just other businesses that I thought were maybe slightly better. My main pick was Tabcorp. I also proposed Ramsay. Tabcorp, I just think is phenomenal. Where Reece is still exposed to those different cyclical elements and competitive elements. Tabcorp is a monopoly. It's a regulated monopoly. There is no competition. Also requires no tangible capital at all. It just earns. It's just a cash machine essentially. It's a very very stable business, at least when there's not lockdowns. But I mean, lotteries in particular has so little variability year to year. People keep coming back. They keep placing bets. There's almost no chance of Tabcorp able to lose money on those because the odds are fixed in a way that it does consistently win over time against the lottery players. And yeah, I think when you put all those things together and then combined with the fact that it's getting better and better, that the pandemic in particular has moved more lottery players online, and that requires less commission paid to news agents because Tabcorp can then sell the ticket directly to them. So its margins are improving. It takes no capital to operate an online business like that, pretty much. And yeah, I think put all that together, and that's one hell of a business.
A lot of people, I think, would be surprised by the inclusion of Tabcorp. Every other stock on that list, we'll go through one more time. Ramsay, Reece, Tabcorp, Goodman, and James Hardie. They all, I think they'd all be acceptable in most people's lists. They all have high returns on capital, high margins, all the great stuff, the quantitative stuff you want to see. Tabcorp is the outlier there, Graham. And just explain to us why the financial metrics don't necessarily reflect the quality that you're talking about.
Well, if you look at plain things like the return on equity, that's kind of distorted over the past year because they had to raise a lot of capital during the pandemic which paid down their debt. See, this was the one issue with Tabcorp that we've always had was it's an incredible underlying business, but management took that underlying business and then tried to accelerate it to the max with debt.
You're being very kind, Graham. I would call the management of Tabcorp some of the worst management in a large business that I think we've got. It's been awful for a long time. I'm just going to say it. There you go. Okay, carry on.
Yeah, certainly management willing to take risks. And anyway, so yeah, that did let the business down. It meant that the company had issues during the pandemic when this total left field lockdowns kicked in. The only thing I couldn't have even imagined their revenue falling as much as it did before the pandemic. But what that meant is it triggered some covenants with their lenders, and then the company had to quickly raise capital to shore up its balance sheet, basically. But if you look at the business itself, it's still just as phenomenal as before, and it has rebounded completely from the initial issues around the pandemic. I think why people don't like it so much is that it's kind of two businesses mashed together. One is the lotteries business, which is absolutely phenomenal. The other thing is the wagering business, which only makes up kind of 25% or so of the company's profits, but that is a very different company to the lotteries division. Wagering is much more volatile. It's a way more competitive industry. They're up against some strong competition in sports bet in particular. And
it
so,
appears to be zero barriers to entry, Graham, with all these wagering businesses floating around making expensive ads.
yeah, I wouldn't say zero barriers to entry, but
Can we
it's
say low
certainly not a
barriers to entry?
monopoly. Yeah, it's just not a monopoly. So it probably wouldn't, if it was just the wagering business, it wouldn't have made the top 10 and probably wouldn't have even made this list of 5 to reach the top 10.
No.
But I think the qualities of the lotteries business more than offset that 25% of the company, which is volatile and competitive.
So my concern with the lotteries business and is the licenses. And if you don't have to me to be a high quality business, you need to own your business for perpetuity. That's really where the returns are, long into the future, compounding. And so, not having control of their own, how long is the license, or what's the? I mean, it's different in different states, is it?
Yeah, it's a state by state basis. They run from kind of the nearest expiry, I think, is the Victorian one. That's a 10-year license, and they stretch up to 50 years, I think, for New South Wales or so. So they are pretty long dated. The average would be, I think it's around 30 or 35 or
But
something
10 years doesn't get
in
you
that
very
mark.
far, of course, in
No.
terms of a quality business. So you've got to presume, if you're voting for it as a top quality business, you've got to presume that they'll be able to renew that license on
Yeah,
similar terms to the existing,
and that
and that depends on the tax revenue, that on their ability to do a great job and bring in lots of tax revenue for, let's say, the Victorian government.
exactly, and that's why they've kind of continued to win those auctions every time they go up, is because there's this. Although you're right, the having to renew their lotteries is a risk, and they have to constantly pay up for them. But the incumbent always has this slight advantage versus outside operators because they have the established distribution network, the infrastructure all in place, everything like that. So although Tabcorp does have to compete at each new renewal, they usually have an advantage over the others, and so consistently win those renewals. That's how they've built up this
And that's because
total
of economies
monopoly.
of scale, essentially. Well,
Yeah,
because they've already built out the distribution. I
yeah,
suppose I'm a
exactly.
bit biased in it because I remember in the UK, Camelot was the original operator of the UK lottery, which was started off in the early '90s, I think, if I remember rightly, part owned by Granada. But they, they had the franchise, the license or whatever for 5 or 10 years, and then suddenly it was taken away because someone else decided. Well, it might have been Richard Branson decided they'd do it cheaper, and so I guess that does happen, but I can see that they have an advantage. But that, to me, is what sort of worries me. Worries me also with Transurban. I mean, that's another business which has been on our list before, but and to a much lesser extent, Sydney Airport, which has 80 odd years left on its lease.
Yeah, Transurban, I would agree with that. I don't think the incumbency advantages in toll roads are as strong as they are for lotteries. And the leases, of course, are shorter as well. So, yeah, I would agree with those points for Transurban. I think they become less important for Tabcorp. For me, my pick was Tabcorp as well. I voted for Tabcorp, and Graham has outlined the case beautifully. I would just add that this is about as simple a money making operation as you can get. Someone in the comments actually wrote exactly the way I feel about this company. Someone walks through the doors, literally hands you over money for nothing. And I just think businesses don't get better than this. I take your point about the licenses, but these are on average 30-year licenses, so you do get a couple of decades go at it, and in that time you do build incumbency advantages that may make it difficult for the license to fall to someone else. Not impossible, but just harder. And the digitization trends actually make all this much better. In the past, this was, there were lots of reselling channels, and the lotteries business didn't quite have control of all of its of its revenue, the margin they had to share with resellers and other channels. All that is becoming increasingly internalized, and so the margins are actually getting better. So a fantastic monopoly is arguably getting even more profitable and even better from digitization.
Doesn't that reduce the barriers to other people? That wouldn't digitization make it easier? I mean, discounts this network that or the distribution they've already built out. I mean, it's easier to build up a digital distribution, isn't it?
It is hard. It's taken Tabcorp a long time to build it out, and you can argue that they're still not the most successful distributor in that game. Look, it maybe on the margin makes it easier. Graham, I don't know what you think about this, if you want to chime in with this as well. But
Yeah, I would say the
right,
same, that it
yeah,
does, by making it digital, Tabcorp's then able to interact with its players directly. It has loyalty programs. It has all their emails, simple things like that that
it
mean
probably
that
knows that you buy lottery tickets wearing your blue underwear on Wednesdays, right?
who knows what they know.
How do they know me so well?
Yeah, but
I don't buy any lottery tickets. I would like to just
No,
put that on
I'd
record.
find it hilarious if you did.
Or I haven't
no,
done for
I
a long
don't
time.
either. Yeah, I think that does, it just improves their position. Even if they lost the license in one of the states, and because these licenses expire at different times, they wouldn't lose it all at once. So it's not as if the company could just evaporate one day. It would be over decades, it slowly loses its position. But what that means is that if it were to lose, say, the Victorian license or something like that, it would be able to, it would still be difficult for the newcomer to then start from scratch, build up those client bases, build up all of the rest of it. They'd have to spend a fortune on
Yeah,
marketing and all
yeah.
that. So
They probably re-establish those old channels. In fact, I would suggest, rather than trying to do it all themselves again.
yeah, I'm not sure.
It'd be interesting. For me, the thing that the downside of Tabcorp, look, I must admit the licenses. Maybe I'm being a bit flippant about it, but the licenses don't really worry me too much. What worries me is lousy management is a concern, and that's kept me out of the stock personally. And then, of course, the wagering business, which is nowhere near as good, would not be a top 20 business, let alone top 10. And that really does dilute the strength of the lotteries business. But of course, I think there's a good chance that won't be part of Tabcorp in the next, over the next 12, 20 months or 20 months or
Yeah,
so.
well,
So
next year we might get a chance at just having a standalone lottery
indeed,
operator.
yeah.
They want to demerge it, so maybe next year it'll be just the lotteries business we get to talk
Yeah.
about.
Might be even up higher on that list. It surely has to be higher on the list, even if that's the case,
Maybe.
especially if we get some decent management on board too. Now, let's run through very quickly these stocks that were nominated. The stock that got that final position, of course, Graham, was Ramsay. You're the analyst on Ramsay. I think this vies along with Brickworks as the company with the longest unbroken run of dividend payments, or dividend payments that haven't been
I
cut.
saw a headline this morning
Yeah.
saying that about Soul Patts, so similar to Brickworks, or maybe that was longest run of dividend growth. Maybe that's the difference.
Ah, yes. Okay.
Yeah. Anyway, look,
Yeah.
They all
And
put out their own pitch. It'll be the longest run of dividends are over $1.05 or something or other.
Yeah.
no, but
It's all pretty impressive though.
Soul Patts
Yeah,
and Brickworks, I think they can
yeah,
bundle them together pretty safely.
yeah.
But the stretch goes back sort of 30, 40 years. I think it's more than 40 years in the case of Ramsay. Give us a quick rundown on what makes this so special, and does it deserve a spot on this list, Graham?
Well, it's definitely a high quality business. Ramsay is the largest private hospital operator in Australia, and it also has pretty high barriers to entry. It is not easy to get licensed and registered to open a new hospital. And so it mainly competes against HealthScope, and then, but even that is fairly low because each hospital tends to be a regional monopoly. Uh, it just doesn't make sense to build two competing private hospitals near each other. So the companies know this, and they then seek out different regions to kind of dominate. So competition is pretty low in the industry. The main competition is against the government, where Ramsay is effectively competing against the public health system. And that has been a bit of an issue over the last few years because private health insurance participation has been declining. So more and more people are choosing to use the public system. But we're kind of seeing particularly during the pandemic, there's a closer relationship developing between the government and the private operators, where the government has been outsourcing a lot of work, surgeries or whatnot, to the private operators because the wait lists are just huge on public lines. So yeah, we've got that balancing effect. It's a very stable business again, in terms of there's really not a lot of cyclicality and demand for healthcare, demand for elective surgeries, this kind of thing.
Maybe in
The
the winter,
pandemic is.
would there be more hospitalizations maybe in winter? Potentially?
I'm not
That'd be the
sure.
only anyway, that wouldn't make much
Yeah,
difference, yeah.
I'm not sure actually if there is any kind of seasonal effect at all. It would be very
Mm,
small. You might end up seeing this balance of maybe higher incidences of, I don't know, flu infections or something being offset by uh,
accidents.
lower accidents in the
Yeah,
car
yeah,
because
yeah.
fewer people are on the road driving around or something.
Mm,
I'm not
mm,
sure, but overall, it's a pretty stable year for the company, and certainly
mm,
one year to the next. Uh, yeah, and when you've got that stability, it's also got a fair bit of pricing power against the insurers. Not, I mean, the insurers are huge, so they push back, but the insurers need Ramsay just as much as Ramsay needs them. And so that does mean that you get these fairly steady, albeit low margins, but there just isn't a lot of volatility in the business.
Graham, there seems to be a bit of a battle at the moment between the insurance companies and the hospitals about how to share escalating costs. Have you noticed that as well? I know some of the insurance companies have been talking about that, and they're being a lot more confrontational with hospitals about bearing some of the higher costs.
Yeah, the insurers are in a tricky position because they have to apply to the government to raise their rates.
Yeah,
So they've got on the one side a government trying to keep rates low because governments aren't going to get re-elected if they keep letting these high insurers put up their
premiums.
prices by
Yeah.
tons. Yeah.
Mm,
And then on the other side, there's Ramsay pushing back because the actual cost of operating a hospital is rising.
mm.
So yeah, the insurers I think are the ones stuck in the middle of it, but
Okay,
that's
so
another story.
okay. JC, what do you think about Ramsey?
Oh, look, I think it's almost a sort of property business, isn't it? It's I mean,
Yeah.
in a funny way, you could say that any high quality property business does could get into this list. I mean, like Sydney Airport, and I mean, you could argue that Ale Property could get into it, even though it's only got a month or so to, because
Mm,
really high quality property is, I mean. It takes a share of economic output and economic growth, and it's always going to do so. It's very, very reliable, and that's really what we're sort of talking about it here. And Ramsay, a very specialist property operator, it's hard to replace a hospital,
mm,
and so the way it profits from those hospitals is slightly different than just charging people rent, but that's sort of how it sort of turns out. But I suppose that gives it a little bit more going for it, because you can run a hospital well or badly in a way that it's hard to run a pub,
mm, mm.
or something else, or even an office well or badly, um, and but so it's a very high quality business, absolutely no doubt. Not a lot of growth, but that's fine. You don't need a lot of growth. You just need, I think, you need to be a high quality business. You need to at least be growing in line with the economy, which I'm sure
Yeah.
it
And
is.
you would think
Um,
that Ramsay does have, even though it can't, I mean, the growth isn't going to be crazy in any one year, but it does have very persistent tailwinds of the
yeah,
aging population,
yeah.
higher utilization rates of theaters, this kind of thing, that they are strong tailwinds, even if it's not going to shoot the growth up 20% in a year or something like that for a different type of business.
Yeah, so I
But
think
they're persistent.
persistent growth, at least in line with the economy, preferably above, and returns on capital obviously would you have to be attractive. At the lowest level, sort of in the teens, for the safest business, I
Mm,
suppose. And so it's all a question of safety and all that sort of thing, and risk. I mean, it's a stock I have owned in the past briefly, but
mm.
or fairly briefly for me. I'm not. I don't own it now. I mean, I might do if it got a bit cheaper. It's a fabulous stock, but not nearly as good as Reece.
Yeah, I would also agree with that. For me, this is not as good as Tabcorp or as good as Reece. I'm concerned about the international portfolio a little bit. I find the operations sprawling. I think hospitals are. I agree exactly with your sentiment, Graham, that these are very localized regional monopolies, and running a whole series of hospitals all around the world just makes. I don't think management is bad, but the task of management is so much more difficult when you're running an empire of hospitals rather than hospitals in a region or even in a country. I think that makes the task a lot harder, and I think you can see that from the returns in the international portfolio, which, correct me if I'm wrong, Graham, have not been as strong as the Australian portfolio.
Well, yeah, they're international. The Australian one, they do have a bigger advantage here. They've got a larger share of the market, uh, and they've just got better established relationships with all kinds of either industry or governments or
Mm.
whoever it is. Their international operations, they're slightly different healthcare systems in most cases, where it's
Yep.
competing, say in France, it's competing against a lot of not-for-profit hospitals, which
Mm.
then causes, I mean, that's very difficult if your competitors don't want to make money.
Yeah.
um,
Yeah.
so, yeah, they're different dynamics in the different regions, but I think overall it's done a pretty good job with the international expansion, particularly given those hurdles. And there are economies of scale to being a hospital operator. You can push back more on consumable purchasing or on all kinds of things. So that advantage does carry through their international portfolio as well.
Okay. Well, JC, you said something very interesting about that any high quality property business could make it on this list. And indeed, we have another one, Goodman Group. This is one, a bit of an orphan in the intelligent investor universe because I think we've all kind of had a look at it, but I'm not sure who's covering at the moment. JC, I'm going to stick with you.
Well, we don't cover it,
We don't cover it at the moment,
but we keep an eye on it. It's look, it's performed phenomenally
hasn't
well,
it? Yeah. Especially
and it
since the GFC. That's,
yeah. Well, that's right. It got
mm,
into a
yeah.
bit of trouble then, but you know, just about scraped through, and is now reaping the dividends, and it demonstrates um, uh, the value of industrial property and the increased reliance, I suppose, of the modern economy on distribution.
Yep.
And it's, yeah, I mean, the trouble is it's insanely
Yeah,
complicated.
I agree with that.
And
Yeah.
I'm slightly struggling now because the last time I looked at it in
Yeah.
detail was about a year ago,
Yeah.
and you sort of, you make your assessment and you decide no, and then you move on, and then you just got to, when you want to look at it again, you've got to spend a day getting to grips with it again because,
Mm.
well, my memory is not big enough to hold all that in it. And my problem with it always looks fantastic,
Mm.
but there are just a few red flags, and to me, it just is slightly fleecing its investors. The returns it makes, it's a bit like a sort of Macquarie sort
Right.
of model
Right.
before it changed, the satellite sort of fund
Mm.
model where it owns,
Mm.
and it just takes a little bite out of those funds it runs at every stage. And look, it makes great money for its investors. It's certainly not complaining. So why shouldn't it? Well, that's true, but again, it just makes you wonder whether that's how sustainable that is.
Mm.
It's been very sustainable so far, and they do fantastically well. But it just combined with the complexity, you sort of look at that and you see those fees coming to it, and I just find that a bit ugly when it just looks like it is earning quite a lot,
Yeah.
which is it makes the numbers look great, but just makes you wonder, I suppose, and wondering and sitting on the sidelines, wondering and not buying the thing has cost us and cost our members really. But there you go. You got to have red flags. You don't have to be in every stock to do well on the market. And so
Yeah,
there
no,
you
I
go.
agree with that. And I don't think there was ever, I don't recall ever a really serious intention to buy Goodman. And I think you're right to point to the complexity. I think all of us have had a bit of a look at it and all of us have been a little bamboozled because Goodman is both it's a builder of industrial property. It owns the land on industrial property. It also manages properties in funds, so it's a fund manager as well. And so at every stage, it's earning revenues from development, from leases, and from fees. And following that revenue through is quite a complex task. They don't make it easy for you either. They don't. I don't find the reporting particularly easy to follow, and that's probably why I've certainly never owned the stock. And the reason for me has been complexity. The good side of Goodman, JC, as you've covered, is the operating complexity. So Goodman is simultaneously a builder of industrial property, a developer of industrial property, an owner, and a sort of a fund manager as well. So all those revenue lines are quite distinct. As you know, it takes rent, earns management fees, development fees, and I don't feel the company it doesn't make it easy for you to really understand the accounts. The numbers are quite difficult to run through and to follow through the whole 3 sets of accounts. And so that's probably kept it off my own personal buy list, and it's the reason I don't think we've ever advocated strongly for it inside Intelligent Investor. But that's not to take away from the actual asset quality here, which is outstanding. So I've had a little bit to do with Goodman because I cover Brickworks, which owns a joint venture with Goodman on its property business. And I think the property business is the best part of Brickworks. I've been saying it for years, and I think the market's finally recognizing that as well. But from covering that, it's clear to me that industrial property, there is a shortage, or there's a scarcity of optimal industrial property, because the location is super important. It has to be on particular freeways. It needs access to particular logistics and transport hubs. It has to accommodate large and increasingly growing truck fleets on both ends. So if you look at what they're building for Amazon out in Western Sydney, it is quite a unique piece of property that not any piece of land could accommodate.
And I think increasingly a lot of technology goes into the warehousing as well, doesn't it?
Absolutely,
So,
it does. Yeah.
this is definitely something you can do well or badly, and they definitely do it well.
And these are
And
hubs now as well. So they have
yeah.
sort of fiber coming through. So it's not just, you can't just pick up any sort of big empty block of land and build industrial property there. There are now dedicated hubs that kind of work and are centralized, where truck routes and rail routes and logistic plans run through. And a lot of them are actually controlled by Goodman, which is a leader in this field. And it's really difficult to actually find a competitor that can dislodge the company now, as long as it remains well managed. And the founders actually sort of said that he's run the business with too much debt in the past. He's avowed debt for the future, and it's been superbly managed since the GFC. So this is quite high on my own personal list. I will just point out the complexity as you did, JC, and that's the reason why I didn't get my vote. But Graham, what do you think about it? And why don't you own it?
Yeah, the complexity reason is the thing that would hold me back from it. If you look at the individual properties, they all look good, but I don't understand
it's
them
highly
enough to have
priced
it.
as well, isn't it?
Yeah, actually, that's a good point. We
So,
forget about the price. It is
I mean,
never.
when we're
but
talking
we're
about
not.
owning it, but if we
Yeah,
when we're talking about as a quality business, then
Mm.
obviously the price isn't the point.
Yeah,
yeah.
correct. Yeah, Graham, you'd much rather own a sprawling hospital empire rather than a sprawling industrial empire.
Probably, yeah.
Now, the final stock on this list, I'm just going to remind myself what it is. Like, give me a
James
second.
Hardie.
There it is, James Hardie. Yeah, I thought you'd remember that one, JC. Well, this is one that I quite like personally. But Graham, let's begin with you this time. Why is it on the short list? Why do you like it?
I don't know much about it. This is not the right.
Okay, not
Yeah,
Graham's stock.
You want to talk to me? Yeah.
Let's turn to your namesake, JC. Let's go.
Well, James Hardie, of course, makes the fiber sheeting that
Take notes here, Graham, for next time.
the sheeting.
that
I
we all see on our
see.
houses. Yeah,
That scribbling sound
fiber
you hear
cement.
is Graham.
And of course, it got into its asbestos problems way in the past. There's some
That's
complexity in
bad.
its. Well, that's right. Look, I mean, that's a long time ago. That's a different management. That's almost a different company.
Almost a different company. Yeah.
You know, eventually was forced to put its hand up. I don't even know the detail of how that worked out, but there's a fund that it pays into to pay compensation, and so some of its profits, a lot of its profits, go on that at the moment. But the underlying business is incredibly strong. It has a position in the market which, it's able to make this sheet. It's extremely effective. It's got great properties as a sheeting, in terms of fire retardants and insulation and all the things you want it to do, weather resistance and all that. And so it's a fantastic product, and it's been gaining market share, and it keeps doing so. And it's quite difficult to make, and they make it in a way which, they know how to make it cheaply. And so, look, it's a fabulous product, and it's gaining market share, and I would expect that to continue. The one problem with it, in my mind, is it's almost. I mean, look, there's also all kinds of different fiber boards, and they've got gypsum products now as well, particularly in Europe. But the problem with it is that really it's in essence a one product company. If someone came out along with a different kind of sheeting which did all that better, then I think that they would struggle a bit. So that's what I don't like about it. That's the only thing. It's just too the threat of substitution, I suppose, in the Porter language. There's nothing on the horizon at the moment, so I'm probably jumping at shadows. I mean, it's a high quality business. We frequently say so in our articles about it, but it just. I mean, I think I gave a list of 15 just in case there was, because I had them on my list, and it was somewhere in there at 13 or 14. I mean, it's a high quality business, but not quite the top 10 for me.
Yeah, I must admit, this was not on my top 10 that I submitted either, but like you, JC, it is a high quality business. I run a sort of a short list of stocks that I want to buy. James Hardie is on that list, even though it's probably outside the top 10. And yeah, look, I don't have much more to add. You've covered the strengths of the business well. It owns the fiber cement market that's gaining rapid market share, and it's maintaining 80% market share of this growing segment. And that's what's really surprised me. I've seen this company in the past at much cheaper prices, at much cheaper multiples, but never bought because I expected it to attract more competition. For a business that has a lot of assets on balance sheet, this generates enormous returns. And I just expected that would encourage competition. Maybe it has, but that competition is completely ineffective, and they have walked away with a lion's share of this growing market.
And the new one of the parts of the new strategy, which they seem to be conducting pretty well, is to market directly to homeowners. So in the
right?
in the repair and renovation sort of market, they're marketing directly to homeowners. The homeowners are beginning to specify the product. So the James Hardie, so they're beginning to get a bit of brand value. Is the point?
They call I think they call this the Intel Inside strategy. Not they call it, but it's known as the Intel Inside strategy.
Yeah,
for obvious reasons.
Yeah, that's right. And so, look, it's a great company, long runway ahead of it.
Yep.
We like it. We've got pretty high price guide on it. It's very expensive these days. But we're holding on as best we can, and but I think not quite. Just because to me it's a little bit of a one product company.
That worries me less than it's a heavily cyclical business. And I'm not sure you can have a truly wonderful business that is heavily cyclical as well.
I think as long as I'm not worried about cyclicality. As long as you manage it and don't have too much debt.
Correct.
As long as you make enough money, as long as you make enough money across the cycle. But
you
obviously,
have to manage a balance sheet.
Yeah, if typically companies don't, and so or a lot of very cyclical companies don't. So look, it's
we've seen
huge
ups and downs in James Hardie over the years, and I think you get a shot. I mean, I must admit the current management and the previous management have been outstanding, but I think you do get shots at buying this at relatively cheaper prices.
I guess the question is whether we're talking about quality businesses or whether we're talking about quality companies. Quality companies encapsulates the balance sheet, whereas quality business doesn't actually bring the balance sheet into it, because you're talking about the enterprise rather than how it's financed. But
Graham, have you scribbled some notes?
Yeah. So fiber cement, you say?
Came last on the vote, the customer vote, the
Yeah,
member vote,
and
13
by a long way.
13%. Yeah.
Yeah. I wonder
Well,
if that's got to do.
actually, last place was half of what the leading
Yeah.
stock was, which I'd like to say was Reece. So it's quite interesting that the last place, 13%, Reece got 25%. So it's actually quite a lot. The votes were very well spread, is the point I'm making.
That's right.
Well, I was actually
Sorry, Graham.
surprised by the opposite. I was thinking that, they all got. I would have thought that one in particular would just be miles ahead, but they all, particularly, maybe not James Hardie so
That's
much,
the
but
point I was trying to make. So the votes were well spread between the five of them, not a big range, as it were.
oh yeah.
So quite a narrow range.
Yeah,
Of
which I guess reinforced why we, the analysts, had difficulty picking between them.
Yeah, I think
indeed.
it does.
They are just all good businesses.
All right, now that's probably a perfect time to end. So we're going to have the top 10 businesses special report released before Christmas, and that will be accompanied by podcasts on each stock, where most of us, and I'm only on one of those podcasts, but all those stocks will get discussed. We're going to squeeze in one more podcast before the end of the year, and we're going to do our customary end of year wrap, gentlemen, so we'll prepare for that. Other than that, I think we are done. Anything else to add, JC, Graham?
Not from me.
Thanks, Gaurav.
Wonderful.
Just to say cheerio, yeah.
Okay, well, JC, thank you for joining us today.
Pleasure.
And Graham, as always, for popping in from Canada.
Thank you.
And for everyone else, thanks for listening.